Wolf Financial, and several other channels, coming to you today with an amazing conversation with John McNeil and Adam Patty. This is an esteemed panel. I'm very excited to have them both on here. We're going to be talking about AI as well as some Warren Buffett stuff a little bit later on in the conversation, but we're going to kick things off really discussing this ETF that the two of you have created and that I'm very excited to be working with, AIS, focused on the AI super cycle. And what does that mean? What are the opportunities to be aware of here? So with that being said, I don't want to waste any time. I want to get right into it. But John, before we kick off, I've had Adam on the channel before. He was able to give a brief introduction. Could you give people an introduction of yourself and a quick background?
Yeah, I was a 6-time serial entrepreneur, and then became president of Tesla. Helped grow Tesla from about $2 billion in revs to about $20 billion in revs in about 30 months. It was part of a great team at that time that did that, and then was the COO of Lyft and helped take Lyft public, and now run DVX Ventures, where we've formed this platform that Adam runs called Vista Shares.
Very cool. Yeah, obviously a strong background there as both an entrepreneur as well as in that key role at Tesla. And Tesla is a company that I would say is embodying this AI cycle that we're going into. So let's talk about it from a high end. We've covered what is a super cycle and what does that mean. So I'll kick it off with you, John, here. Talk to me about where the vision came from when you think about AIS as an ETF and the holdings inside of it, and then this more general concept of we're pursuing an AI super cycle and getting exposure.
Yeah, I think like most investors are lucky to be alive for one super cycle maybe in their career. They hit the internet revolution or the industrial revolution, if you want to go way back. And we've got several happening simultaneously right now. We've got an AI revolution for sure. We've got an electrification revolution happening on a super cycle. And then we've got robotics and biotech. And within AI, what I started to look at was the ETFs were all concentrated at the very, very end of the funnel. Basically, you could, the plays people were making in ETFs were basically the NVIDIA and Apple and Google and Microsoft and AWS. And what I knew from being a CEO as long as I've been is the end producers get a margin, but the supply chain gets the bigger profit pool. We often joke that the supply chain guys were flying around in jets while we were flying commercial and economy when we were traveling. And so we looked at the AI super cycle. One of the guys that I used to work with at Tesla has led the build out of the AI data centers at Google for a number of years. And so he and I started to talk about what goes into the build sheet of an AI data center. And it turns out there's some surprising things. Like there's 4 times the fiber in an AI data center as a regular data center. There's a whole lot more networking software, a whole lot more cooling that goes on. And it turns out when you look at NVIDIA, it's like 5% of the build sheet. And so if you're in an ETF that's ignoring 95% of the stuff that's in the infrastructure, you're missing out on that profit pool. So we formed AIS to give investors, really democratize their access to this build out where you see kind of weekly billions and billions of dollars being announced in data center builds for AI. And we wanted to give investors direct access to that. At the time, and really the only way you get direct access to the full infrastructure is if you're a super, super accredited individual at BlackRock. That's the only way to get in to their infra fund. And we wanted to democratize that with AIS.
I love that. Adam, this mission obviously really speaks to you as well. What do you see as the next frontier here for investors approaching this?
Well, in terms of the AI super cycle itself, I mean, look, I think John said it perfectly. I mean, just today we heard from NVIDIA and Amazon reaffirming that there's no slowdown in demand for data centers. So, there's certainly been a pullback in sentiment in the AI space over the last couple of months with all the tariff tantrums going on, but the narrative or the underlying story has not changed. The dynamics, the economics of what's going on globally. This is a massive 3 to 5, 10, 20-year build out that's occurring right now. So while investors are many times focusing on the end consumers or the end consumer applications being driven by the Microsofts and the Amazons and the Apples, the reality is that while those companies are the ones that are in fact putting hundreds of billions of dollars into infrastructure, they're doing so because they need more compute power, right? They need the power to develop these new models so they can create new applications that add value to their consumers that will eventually drive income for them. But we're not there. Where we are is that the profits are being made in the cooling companies and the fiber optic cable, as John was saying. And that's going to be happening for the next 3 to 5 years before I think there's enough compute out there to actually drive the type of innovation that the Microsoft really need to create incremental revenue streams for themselves. So we are the only ETF AISs that provides that type of exposure. And, we think it's a superior way to gain access to artificial intelligence right now.
Yeah, it is really unique to me that this is pretty much the only ETF that I've seen that's targeting that area. There's plenty that are targeting, like you said, right, the end companies. They'll make kind of like a Mag 7 type ETF, but this is very different and really focuses on a whole different style of company. And like you're saying, these are probably the ones that are more likely to benefit in these next 3 to 5 years. So with that being said, John, can you talk to a little bit, I've spoken with Adam about this before, but kind of the actual process for actively managing an ETF like this and what goes into that?
Yeah, it's a great question. So what we find in these super cycles is the tech kind of moves quickly. And so one of the big shifts that's even happened over the last quarter in AI data centers is they're moving to different substrates, which is basically different materials to put the chips into and make the chips out of. And so we'll actively manage the ETF to pick up on that. We've got one of the leading AI experts. He runs Grok's data center, Sunny Madra, as an advisor. And Sunny's literally on the ground as they're building their data centers. And he's flagging these sort of things for us. And we're talking with other technologists in the field. And so a few weeks ago, we were on a Signal chat together. And I said, Sunny, tell me about these new substrates. He said, funny you should ask. Because there's a major shift happening, and it's a really smart question. So we started to then dive into, okay, which companies are providing this, and how would we weight them back into the index, and went immediately to work on that. So if you have a set it and forget it unmanaged ETF, again, you're not going to be, as an investor, you're not going to be able to take advantage of the kind of movements in tech we're seeing.
What's the biggest? Yeah, sorry, please.
I just want to jump on that because I can't overemphasize how important what John just said is. Because of how dynamic the industry is, making quick moves is important, or at least being able to make quick moves. We're not waking up in the morning and saying, let's buy this stock or that stock. We have a very rigorous process that goes into doing our analysis. But I do want to mention that, so our investment committee, made up of John and Sunny as the AI gurus on our investment committee, they've grown up in this AI industry. They didn't just wake up yesterday and say, it's an interesting industry, let's get into it. They've grown up in it. They know the companies. They understand the supply chain. They understand the players. Sunny in particular understands who's winning business, who's losing business, because he's building data centers. So, our investment committee is really made up of two components. One is kind of the practitioners, which is John and Sunny, who really understand exactly what's going on a day-to-day basis. And then kind of the portfolio construction people. That's Professor Robert Whitelaw, who is the former dean of NYU Stern School of Business and former chairman of the finance department at NYU Stern as well, and then myself. So we're kind of on the portfolio construction side. When John or Sunny say, we need to be looking at these substrate companies, we will help out with the analysis, provide to them so they can assess where the opportunities might be. But then as importantly is when a company needs to come in or out of the portfolio, it's really understanding the risk dynamics of the portfolio and determining how best to take it in or put it in to for additions and deletions into the portfolio. So that's where someone like Whitelaw, who's a globally renowned expert in portfolio construction, adds a lot of value. And I think this really differentiates us not only against the other ETFs, which don't do this, or even actively managed mutual funds or some hedge funds, frankly. Hedge funds, there are some hedge funds that will dig into the bill of materials and they'll use their team of analysts to do that. We're doing the same thing, but we're doing it for a much broader retail audience.
Yeah, speaking of that retail audience, I kind of want to get into their mind for a second here. How do you, what do you think is the best way to simplify this down for a daily retail investor who doesn't have the time to go ahead and do that deep dive research and really understand the impacts that AI could be having and, make 3, 5, 10-year projections?
Go ahead, Adam.
I'll just add one point to that is that we think transparency is critical. So what we've done is we built this bill of materials process from John and his research team who developed this. But we built it into a rules-based process that is available to everybody. So we have filed a patent on it because it's novel. It's never been done before, but it's available to investors. So they can go on our website, pull down the rule book and say, wow, we understand why SK Hynix is the number one holding in the index or in the portfolio. So we think transparency is real critical, not only for retail investors, but really all investors. But we're trying to make that, that transparency really the core of what we're doing. What we're also doing is we're doing a lot of content, not salesy content. We're doing research. So every other week we come out with a newsletter. It's our AI Insights newsletter, and it's posted right on our website. We put it on social media, and what it is, it's a digest for investors that summarizes all the key news that's occurred that week or the last 2 weeks, how it impacts different portions of the supply chain, and how we're viewing that. So we think that's important as well to educate the investors.
Yeah, John, having worked at Tesla, you're probably a little bit ahead of the curve in regards to what you expect AI to become. For my retail audience, what do you think are the greatest opportunities here? And then kind of how do those relate back to this investing side of things?
I think like the problem that we've worked on at Tesla and I've worked on since is maybe the mother of all AI problems, and that's autonomous driving. It requires enormous compute to train the models. It requires super significant compute on the cars themselves. And I think given that that's maybe one of the most advanced cases, it sort of points towards where AI can go, in the sense that the cars are the edge, and there's more and more compute being added to the edge. And so I think investors are going to see, and we're probably going to introduce product around this eventually, where on the training end and the inference end of the spectrum, they're building data centers to do that because you need massive clusters of chips to do that. But then when you're asking for inference or answers from the models on the edge, you're going to want to have compute on the edge that's appropriate for that. And there's a bunch of folks that are battling right now to provide the chips for that. It's not just NVIDIA. It's going to be hard to put a $25,000 chip in your phone, but it's people like Qualcomm, it's people like AMD, and it's people like Apple who are trying to figure out, okay, how do we put enough compute at the edge so you can actually get really compelling AI, whether it's autonomously driving a car or an assistant that can be an agent to book travel for you. And I think that's where we're going to see a general trend of AI towards the edge. And there will be a new set of players that will emerge to provide the kind of hardware and software that's going to make that viable.
Got it. And then what would you say are the biggest challenges right now within that area? Because there's a lot of hope and a lot of opportunity. And I think AI has got a lot of hype behind it right now. But where's the challenge lie?
I think it lies both in the software and the hardware. So you've got massive cost to train now these models, and there are models that are being developed like DeepSeek that can piggyback on the back of other models and train very inexpensively. But when you go to ask those models for answers at scale, which is called inference, you still have big investments in some hallucinations. And we've seen that even this week with OpenAI's O3 model. It came out. It's a reasoning model, which means it's got several levels before it gives you an answer. And they're seeing an enormous amount or an inordinate amount of hallucinations on that model. And so that's one of the challenges. And that speaks to the hardware challenge in training it thoroughly, and the hardware that's available when you answer or ask it for a question and it answers. But it also speaks to the software challenge that we're facing. And if you look at the quality of answers per unit of CPU, those are definitely going up over time. But we need to make more rapid advancement. So you can do things like, I was traveling yesterday and I needed to change a flight. And I literally wanted to say to the assistant on my phone, an AI assistant, change me from this flight to this flight, change all my cars on the other end, and book me an Uber when I get to the other side. And that is just not possible today because the compute and the software aren't ready for it.
Yeah, those are good points. Real quick, I do have a question for Adam, but before I do that, a couple of comments have been coming in. We got a John is the best with an exclamation point coming from the audience. Someone threw in there, many don't acknowledge Tesla as an AI player yet. So going a little bit underneath. And then they did ask so for your guys' social accounts as well. I know, Adam, you've been getting pretty active on yours, and definitely would encourage people to check that out. It's just at Adam Patty. So that's an easy one to find. And then John, is yours just at John McNeil as well?
Yeah, exactly. Yeah.
You guys have the easy social account. So it's
Totally easy.
literally
And
their names, guys.
Yeah.
Yeah, just their names. You can go ahead and find them right there. I appreciate the 5,000 people who have tuned in so far as we've been going through this conversation. Adam, let me bounce it back over to you. I'm just curious to get a little bit of a picture behind the scenes. So you've got, John and Sonny that are really going out there as those AI brains. They're communicating back to you. You're making these moves within the portfolio. What are those conversations like behind the scenes? Like, give people a look into, okay, an actively managed ETF.
Well, firstly, it's an honor to work with someone like John and Sonny. I've been successful in my career, but there's a different level of knowledge and success. And so I'm very honored to have that opportunity and to learn. Frankly, every time I speak to John about things, I'm listening to him right now even, and we're talking to Sonny and listening to him. The insights are just 3 levels beyond where most people, including myself, can possibly really understand them to be. So, because it's one thing to have knowledge or insights, but how does that really apply on the ground? And that's where I think the difference really lies in what we're doing with AIS. It's great to say, well, this chip is spectacular and XYZ company is coming out with it, but what's the use case for it? Who are the customers for it? What does their pipeline look like? And that's where the knowledge of being an operator really comes in. So, I think it's a very exciting partnership, and I think it works extremely well, particularly again with Professor Whitelaw on there, who brings a whole different perspective. He'll say, well, the beta of this company is higher than the beta of the one we're removing, so we need to make an adjustment in the portfolio to make sure the beta exposure, so things like that, or volatility, so we're looking at all these things in the portfolio to make sure that we're providing a product in the form of an ETF that is a solid, high quality solution for investors' portfolios. Because that, at the end of the day, is the most important thing. We need people to have good outcomes. And, without that, we don't have a company. So, you got to under promise, over deliver, and, just be very transparent and straightforward on what we're providing and what we're not.
What are the conversations like in a market like this, especially right now, where you're going to have real good days and real bad days from a return perspective, right? On especially something that is involved with tech. You've got tariffs, which there's concerns we have heard back and forth. Are there going to be tariffs on semiconductors and electronics, or are there not, right? And for different countries. And so you have the ETF right now, which the 1 week it's up 9%, right? The 1 month it's down 12%. These things go all over the place, and so I'm just curious how you think through that.
Well, look, this type of product is a long-term hold. This is not a trading product. This is not a time-to-market product. This is a type of solution that you believe in AI. You believe that there is a long-tail opportunity, and you're looking for the most efficient way to capture the profit pools of that industry over time. So, and that's what this is. So, look, when we launched the product, we launched it at $25, right, in December. And now we're down, I don't know, about 20 and a half or something.
21, yeah.
Yeah, 21. So, it certainly had a drawdown, but frankly, I think it's a good thing. A lot of the froth has been taken out of the market, and now it's giving investors an opportunity to get in at prices we haven't seen for probably 9 months to 12 months. So I believe it's a good entry point. I'm a customer, and because I believe in the long-term focus or the long-term prospects of the industry overall. And I also believe in the process that we use, and are wholeheartedly believe in the infrastructure angle of it, which I think is critical now.
Yeah, 100%. Let's take a look for a second at the holdings, which you guys keep nicely updated, right? Everyone, you can go in, you can see these are as of 4/24/2025. And you can see right now there's, a few different weightings across the board. Some big holdings up top here with Sky Hynix, Taiwan Semi, Micron. Those seem to be where there's decent concentration. And then throughout, John, when you see, this collection of names, maybe talk to me about what stands out to you for investors that are looking through here. Like, how should they be connecting the dots?
I think You connect the dots with probably the multiple layers that are in an AI data center. So you start with the infrastructure in the AI data center. So as everybody knows, you have to have a lot of power coming into these things. And so there's high voltage electronics that really start at the edge of the street. And those are the transformers and other high voltage electronics that bring power into the data center. And those started out being a dozen suppliers and really big boxes, and now they're down to a few suppliers and one box. And so you see companies like ABB in our index, because ABB is now the supplier of that very different box as things get more sophisticated. So the first layer is you're bringing power in, and then you got the infrastructure in the building itself, which you've got cooling, you've got racking, and then you've got servers. And those servers come in, and they've got several layers in them. You have the AI server for sure that's in there, and so that is that's the NVIDIA chips that we all hear about. But those chips are really blade computers. Layered on top of that is networking, where you've got to network all these chips together. You've got a security network layer that makes sure that you're keeping data secure. And so you can see there's a cake of many layers that gets built up here. And we're capturing the players at each one of those layers. And as those layers change and become more sophisticated, we're capturing the new players that are coming in. And believe me, this stuff's moving pretty rapidly. So that gives you a sense of like how this index is then built up. And we basically take the build sheet of the entire AI data center, and we weight the stocks based on the amount of dollars that they represent in that data center investment. So we're not weighting them by market cap. And that's a pretty big difference. That was the thesis around Vista shares, is that we're not weighting things by market cap. So you end up with a copy of the Mag 7 or the QQQ. Instead, we're weighting them by their contribution to the AI super cycle, so that you can get, again, as an investor, a real exposure to the players versus a market cap weighting that gives you quite a different exposure.
Yeah, it's nice that you pointed that out. I think it's important for people to understand those differentiations. One other follow-up question on that. When I've talked to people about AI, they seem to swing one of two ways. I think people feel like we're ready for it. The time is now, and we've established that this is a long-term hold. But there's definitely people that push back and they talk about 2001 and say, "Hey, the internet, right? We just kind of had that bubble ahead of its time. Is it the same thing happening now with AI, where this is the future, but there has to be, a move upwards, downwards, growing pains, things along those lines?" Transparently, I wasn't unfortunately investing yet in 2001, so I'd love to hear your perspectives.
Adam, you want to take that?
Yeah, I mean, yeah, you go back and look at the companies that actually did or succeeded long term from that internet bubble, and what were they? They were the infrastructure players, right? We're not buying the pets.com. You might not even know what pets.com is, but
I do. Yeah,
okay. Yeah. So I mean, we're not buying pets.com. That is, to us, that's the front consumer layer that we're not interested in right now. What we're interested in is the infrastructure, the picks and shovels, wherever they may be around the world. And, those are the companies that, of course, they got blew up in the dot-com boom or the bust as well. But of course, the ones that were high quality came back. Now, we can't always identify who every single winner is going to be long term, but that's why you have a portfolio, right? So we have 83 companies in the portfolio that all fall within the build sheet of the AI data center. And again, we're reviewing the revenue, we're reviewing their pipelines, we're reviewing how much AI revenue they have. So let me just give you an example. There's a bunch of different cooling companies. Cooling makes up about 30% of the cost of an AI data center, believe it or not. And there's a lot of companies providing cooling. But, so we're not interested in a cooling company. We're not even necessarily interested in a data center cooling company. We're interested in an AI data center cooling company. So we're looking at the revenue, AI direct revenue from the company. So a Vertiv, for instance, which I love Vertiv. I'm just a Vertiv fan, and it's gotten hammered over the last couple months. But, they're the leader in the cooling space. So, we feel that kind of insight and that kind of rigor is really what kind of makes us different, and, will differentiate us long term.
I like that, especially with the specific examples. John, I know we just have you for a few more minutes. Do you think Tesla could be considered a picks and shovels play at all, or is that not really their area?
I think you can, as one of the audience members, Tesla pointed out, I think you can consider Tesla an AI player for sure. They are partnering in different ways with XAI on data center and cluster. And so it's really XAI that's doing the picks and shovels. And the application layer is really Tesla's autonomous driving initiative. And so I think you can consider Tesla an application layer company within AI. And then XAI would be their picks and shovels.
That's a good way to put it. Obviously, there's a whole ecosystem going on there. I know we're going to keep the conversation running here.
Yeah.
John, I want to make sure that we're respectful of your time. Any other, I would say, thoughts from yourself, just as, my audience, if you're in here, I encourage you to go type in Vista shares or type in AIS, the ticker, and do some research, right? This is just a nice place to start with that research and get the deep dive in. John, any just guiding words for people that are digging deeper into this ticker?
Yeah, I would say compare this ticker to some of the others, and then you'll see the difference. And what we're after here, as we've said, is not a carbon copy of the Max 7 or of the QQQ. We're after different exposures. So you can dive in, you can see our holdings, and you can see where those holdings play in the stack if you do a second click on the research. So I'd encourage people to do that because I think it'll help them become better investors.
Yeah, that's one of my favorite things about it. It's not double lapping your exposure, right? It's not one of the things where you look at it and you go, well, why do I need this? It's a whole different tactic and approach. And it's something that's going to help you diversify in an area that has a lot of high upside potential.
Totally agree.
Awesome. John, thanks so much for joining us. Appreciate you making the time. Looking forward to talking with you and again, hopefully in the near future.
Same. Good to be with you.
Take care. Take care. Adam, stick around for me.
All right.
All right. Very cool. Very cool. That was fun having him on. Obviously, I see why it's so valuable to have him as one of your business partners, right?
I mean, he's brilliant. You know what? There's brilliant technologists and there's brilliant business operators, and he's both. I mean, I've never actually met somebody like him before my entire career, and he's a really nice person, which is always a good thing as well.
That's the three-way combo, right? Yeah, smart, knows how to execute, nice person.
Yeah, absolutely.
I like it when you can get that. Okay, cool. So let's talk a little bit about Omaha, because as you mentioned, this is something that has been really picking up steam. You're seeing a ton of volume coming in on this at the moment. Again, for those that are unfamiliar, this is OMAH. This is the Vista Shares Target 15 Berkshire Select Income ETF that allows you to invest like Buffett plus some income, right? With that 15% income target. This has 10%, a little bit over 10% of the ETF inside of Berkshire, then holds several of those top holdings, but also is running a covered call strategy. I see now it's up to 15 million AUM. I believe last time we talked, it was at 10 million AUM. So that's 50% growth, not too shabby, especially when the market hasn't really done too much in that time.
Well, and the incredible thing is we had 43 creation units yesterday, and we've had 27 today. So 15, I don't even know what the math is on that. I have to figure it out. But 15 is going to probably 35 or 40 by Monday when it all clears.
High volume today too. Average volume on this is right around 250,000 shares today, trading 618,000 shares so far.
Yeah, very fortunate. I mean, we're just very fortunate. It's a great product. I mean, I don't know what else to say about it. And of course, let me back up. It's a great product if investors do their research and determine it's right for their portfolios. And of course, you want to, long-term track records are the most important thing. We did launch this in March, but here's the difference. So again, we're not coming up with a portfolio here and just winging it. This was a highly researched methodology. We went into the market and we tried to determine what investors were looking for. And there's a huge component of investors that are really excited about kind of consistent income generation. And what's amazing, it's not 20 years ago, it was all the old guys like me who wanted the income. But now it's actually a lot of younger investors that are much smarter than I was when I was that age, where they're looking just to build a portfolio and continue to get that income every month, every quarter, whatever it is, to build that portfolio for their retirement, 30 years down the road, which is a very smart way of investing. So, knowing that income was important, the key was then, all right, well, what's missing in the marketplace? So, if you look at what, some of the most popular securities out there that don't pay dividends, what is probably the most popular? It's Berkshire Hathaway. So BRKB is, incredibly popular company, Berkshire Hathaway. It's run by the best investor in the history of investing, Warren Buffett. And they do not pay dividends because Warren likes to keep his cash on hand for, new acquisitions. And that's what's made him successful. So, or one of the things that's made him successful. So, so we started looking at that and doing some more research, and it became very apparent that if we created a portfolio that was made up of BRKB as our top holding, it's always our top holding, and then we buy the next 20 largest holdings of Berkshire Hathaway. So we have 21 total equity positions.
Right.
So it's a very diversified portfolio, made up of, everything from an Apple and an Amazon to a Coca-Cola to a Chevron to financials like American Express and Bank of America and Citigroup and Kroger. So, these are all Berkshire Hathaway's top picks based on the allocation sides in Warren's portfolio. So that is a very solid core equity holding, we believe, for investors. And then the key is, how do you create an income overlay on that that generates robust income, but not too robust? We don't want to have one of those products that, pays out 100% and then
right.
is destroyed. That's not what we're trying to accomplish. So we picked 15% as an income target annually as a good amount. It was kind of a little bit above what many others were providing, but way below what some of the more aggressive strategies were. And then we pay it out monthly. So we aim for 1.25% monthly. Our next declaration date is actually tomorrow. So we'll be coming with our 1.25 announcement tomorrow, which, I've gone through that already. It's there. So it's a great product. So just really pleased.
It really is. And I get a few questions when I talk about these because they're becoming more popular, right? These covered call strategies. What is the potential downsides? Like, why would somebody, I guess, be more inclined to hold just Berkshire over something like this and vice versa?
Well, I think it has to do with research and understanding what you're buying. So when you buy a covered call strategy, whether it's this one or whether it's S&P 500 focused, whatever it is, you're not getting 100% of the upside. Okay? You're not getting 100% of the upside. So, if we won't keep up with BRKB over time. And, over the last couple of weeks, I think we've outperformed it. A few weeks before that, we underperformed it, but we will not keep up over time. We'll give 70 to 75% of the upside. And that's because of the income overlay, right? So we're selling covered calls, we're selling call spreads. And so that's depressing the top line growth potential. So that's important to know. On the downside, it works a little bit on the flip side where we may be protecting on the downside a little bit. It's not kind of a stated goal of the strategy. So we're not a buffered product or one of those. So I don't want to overstate it. But what we are is, because of the covered calls, maybe you're getting 90% of the downside, 85%. Over time, again, not necessarily on a daily basis, but over time. So I think investors need to understand that, because if they buy it thinking it's 100% of the upside, they're going to be very disappointed. So that's definitely a risk. The other part of the risk, of course, is just, having somebody run the covered calls that doesn't know what they're doing. I mean, it's a sophisticated strategy. We have very sophisticated people running it that currently run around 10 billion in ETF income strategies currently. So they have a lot of experience. There's, I think, 5 people on the team doing it. So, if people are out sick, we have backups, because this is a daily portfolio rebalancing type of situation, particularly when you have a lot of new assets coming into the fund. You need to keep resetting your calls, which is important. So it's a daily active strategy. It's very time consuming, very research driven. It's a data driven strategy. We don't have cowboys in there saying, let's do this, let's do that. So we think it's important. So, but overall, it's a lower volatility strategy. But just know what you own, and do your research before you buy.
For sure. And this is kind of just like a question I'm just like curious about. With Jay, like you mentioned, he's running billions and billions of dollars on that side. Is that something where you think like, okay, that team's going to have to expand? Or is there ever issues with like, hey, they're also doing this for other firms with, similar type products? I'm just curious how you think about that.
Oh yeah, I mean, well, the team has been expanded significantly. He's got a ton of capacity. He's not doing this exact thing with other firms. This is very unique,
Okay.
not in terms of the process of the operations, but in terms of kind of the outcome of the strategy. He's not doing another target 15 type strategy.
Right.
Yeah, I mean, look, I mean, you're always worried about, just operational risk, right? Of course, but they're the best in the business, and Jay he's a guru. He's a guru. He knows he's a guru. He knows what he's doing. He's been doing it for many, many years, and he's got a big team around him doing it.
100%. We talked about AIS being that long-term hold product because, it's 3 to 5 years probably for some of these picks and shovels plays, but then AI can ramp up from there and other pieces. What do you see for OMAH?
I view it the same way. I mean, we're these products are portfolio construction tools. So we think it's the two use cases that we see are really twofold. It's first as a core portfolio allocation for your core equities. So if you own SPY and you own the Qs, you own EFA, EEM, whatever it may be for your emerging markets exposure, you use this as your core exposure. And so that's one, clear use case. The other use case, which is actually very interesting, is that if you own BRKB and you're not getting that dividends that you probably want, if you're looking at this type of strategy, then what you do is you carve off a little of your BRKB, or just add, or you could just use it and you just add OMAH in addition to that. This way, you're creating kind of a synthetic dividend on your BRKB exposure, which is nice. It's a really nice way to do it because we're providing, I don't want to say identical exposure to BRKB, because remember, Warren Buffett has more than 20 holdings. He's got a long tail of other companies. So we have the top 20 holdings. But it's a similar equity exposure. But you're getting that kind of the income overlay on top of it. So it's a really great way to drive income, along with that type of Berkshire Hathaway exposure.
This is kind of a funny question, but when you're putting, the name Berkshire into the name of the product or, other things like this, is there any communication that has to happen with Berkshire Hathaway of like, hey, we're going to create a target 15, Berkshire product?
Well, we're not affiliated with Berkshire in any way, shape, or form. It's a Berkshire Select. We're selecting certain securities from Berkshire, but we're not affiliated with them at all, clearly.
Clearly, yes. And I just wanted to double check on that. Want to talk for a second, just some of the holdings that are in here as well, because I love going through Berkshire's holdings. It helps me just find gems. And now, you've transported that over. So by the proxy, you now have these amazing holdings, right? Plus some of that income that can come on top. So let's just take a look for a second at some of these names. Obviously, Apple is a stud in this area and has stood out for a long time with Berkshire American Express. But there's a couple, like I went through and I didn't realize, VeriSign. I don't think tons of people have heard about VeriSign, would be my guess, when you go in and look at it. But when I was looking at this, I was like, wow, this is a powerful, really strong stock. And, I was looking through and I was like, wow, in a down market this year, it's up over 21%. So I feel like, and maybe you feel similarly, by tracking Berkshire and specifically those top 10, you kind of get exposure to the most convicted Warren Buffett positions. Plus, then you're having someone like Jay running option strategies. And it's like, I kind of get best of both worlds.
I agree. VeriSign's been the top holding or the top performing holding in Berkshire Hathaway this year. Very interesting company. I mean, look, he's Warren Buffett for a reason, right? He chooses some very interesting companies that he gets in at what he believes to be the right price. But it's extremely diversified, right? I mean, you got a Kroger on one side, and then you've got, Apple right there as well. So he's got, a very well diversified portfolio with that value tilt, which I think is important in these markets. So, we're coming off multiple years of market performance that is really momentum driven. So if you look at kind of the factor exposures in the market, momentum was the dominant factor for many years, but that's come off now. So now the dominant factor is quality and value. And that is exactly the sweet spot of where, Omaha or OMAH sits because of the holdings chosen by Warren.
Yeah, it does stand out to me continuously. And I would agree with you on that point. Curious, have you ever met Warren Buffett? They've got the shareholder meeting coming up for Berkshire.
No, I've never met him, unfortunately. It would be an honor.
Yeah, no, it's super cool that he's still doing those meetings and kind of sharing that wisdom out. And obviously, with your firm building something like this, you clearly have that respect for him as well when it comes to these different pieces. So it makes sense to me. What would you ask Warren Buffett if you had the chance to ask him a couple questions?
Oh gosh, you know what? It's funny because he's so written about. He has so much wisdom out there. You feel like you almost know him, even if you don't. But I would just love, again, to hear from him. What were the best decisions he's made in his career, and the worst. And how do you adjust from the worst or the best, right? But I think learning about that from great people is it's amazing to me. I really like to hear about that, because then you can try to model your behavior to some extent based on what the learnings are from these brilliant people.
Maybe I'll use this as an opportunity for my followers to maybe learn that from you. Adam, as someone who's been in the investing game a long time, like what are your best investing decisions and the worst so that my audience can get some takeaways?
Oh, well, I'll tell you, my best is to do my research and have a plan, have discipline, and stick to the plan, and be patient. Um, Investing it seems like a game sometimes, and the way some people talk about it, and even some of the products out there seem gamified to a large extent, but it's not. So I think you have to have a well laid out plan. I think you need to be diversified. Diversification is key, not only in a specific product like this, but across your portfolio. You don't want, it all depends on what your ages are and what your risk tolerances are, but you don't want to be too over concentrated in any given positions. And you want to be diversified across asset classes as well. My worst decisions, are always when I go against that. I mean, it's, oh God, this stock is moving, I got to buy some. I always buy it too high. And then I'm always, stuck with it, letting it ride down, forever. So, stock picking is a tough game. Well, I shouldn't say game. It's a tough way to make money. You gotta really be lucky and know your stuff. And I think it's equal parts knowing your stuff and lucky.
And giving yourself a long time horizon, right?
Stock picking for sure, because you got to hold something. If you time it wrong, you're done. But that's why I stay away from that. I think again, having the plan and having a well diversified portfolio is really the key. And there's also research that indicates you don't want to be too diversified. Any more than 30 holdings, I think the number is, and then you're not getting the incremental benefits from diversification. So you don't need to have S&P 500 exposure and something that looks exactly like S&P 500 necessarily. Having one of them is good. And I think on some of these core beta exposures, fees are important for sure. You look at a VU versus SPY. Buy VU. It's cheaper. It's the same exposure. So that adds up over time. Now with a product like this, people say, oh, it's expensive. It's 95 basis points. Yeah, it is. And the reason for that is twofold. First, to run this options overlay is incredibly time consuming and incredibly expensive. Have 4 or 5 portfolio managers looking at this thing every day and trading, 50 times a day sometimes, depending on what the inflows and outflows look like of the portfolio, based on, the market, based on, investor, buying shares, new creation units come in. So it's very expensive. The other thing I say on that is, if you look at some of the other products that have more S&P 500 exposure, they're priced at around 68 basis points, and they're providing around 12% annual returns, annual income. So we're providing 3% more annual income for 28 basis points more. Seems like a good trade to me. So, but generally, I would say fees are extremely important, and you need to be cognizant of that.
I'm glad that you pointed out for people, right? Like some people might just want to try to gloss over that area, but instead you pointed out and you talk about the reasoning.
Well, it goes back to transparency. And I've been around the block a few times in this industry, and I started another ETF company years ago. If you're not straight up with investors, they see right through you, and it's no good for yourself, your own personal brand or the company's brand. We're not going to hide behind anything. I'm happy to answer any question from any investor. And that goes, so transparency is crucial, both on, the investment methodology, but also in terms of your corporate structure, your operational structure, your fees, and all of that is very important, I believe.
Yeah, we're on the same page there. And I think that retail appreciates that pretty heavily. I'm curious your thoughts when you look at these products. how are you differently approaching, retail versus institutions? And what do you think the two different sides care about differently when it comes to items like these?
We're not approaching them differently at all. These are institutional class products in AIS and OMAH. They're both institutional quality. I mean, they're not slapped together. They're not, just put together with the branding angle to try to get some assets in the door. We believe that these are products made for the long term and for the long-term investor as core holdings. So we believe that's really important. So our approach is no different on the retail and institutional side. The presentation that John and I gave on AIS is exactly what we're doing in front of RIAs or endowments or whomever it may be. And the same thing with OMAH. I think the same fundamentals apply regardless of who the investor is. And that is, again, the transparency, being straight up and explaining in detail exactly what you're doing and what the investor can expect.
When did you start working on the OMH ETF, kind of the conception of it? Because, obviously it's great timing to launch it right now. You have every billionaire in the top 15, besides Warren Buffett, is losing money hand over fist this year. And then he's up 15, 16%, right? So I'm just curious, was it already once the year started and you were like, wow, Buffett's really outperforming in comparison, or was this even earlier than that?
Oh, way earlier. I mean, look, I'd like to take credit for the timing, but that was very just fortunate. We started working on this. Oh gosh, it must have been in the fall last year. Just developing the strategy, thinking.
So even before that August drop with everything with Apple and things along those lines.
Yeah, I mean, we were. There's a long lead time to getting an ETF to market. If it's new, so you have to, or at least our process is you determine what the strategy, the idea is. What's the crazy idea? Okay, here's the crazy idea. Is it doable? What does a portfolio look like? Okay, here's the portfolio. What are the risk parameters look around that portfolio? Once you have that, then you go out and talk to people. Talk to the smartest people you can find to poke holes in it and say this is no good, that's no good, that's stupid. To make sure that you're doing the right thing. And then once you do that, then you have to, file it with the regulators. And that's, you have to develop the registration statement, the prospectus. You have to get it into the SEC. That's a 75-day process. And then, so it's a, if you're doing it right, it's 6 months before, between having a good idea and getting it to market, unless you're rushing it, but we don't rush. So, and look, that can cost us some opportunities, but I'd rather be buttoned up and make sure that we are buttoned up and that the products are the best they can possibly be before we bring them to market. I think it's important.
Yeah, I just appreciate you. I feel like people don't often get to see this side of things, right? Hey, the ETF just popped up one day and there it was, right? But there's so much work that goes into it on the back end.
Yeah, absolutely. So we filed for 4 additional income products as well.
Oh, wow.
Approved, and I can't confirm 100% yet, but it most likely looks like we're going to launch another one the first week of May. And that's going to be not another Berkshire product. This is going to be, I don't know if you're familiar with factor investing. So, there's the main factors are momentum, quality, low volatility, and value. Those are kind of the 2 most used factors in the investment world and the ETF world. So we're bringing out a quality product. So it's a quality factor tilted product portfolio, U.S. equities, again, with the 15% overlay over it. So it's never been done before. That took months and months and months to get right, to make sure that the factor loadings were proper and it really was, again, providing what we said we're going to provide.
2 questions on that. One, with a lot of yield products in the space, are you specifically trying to do what you just said? We are trying to create things that we're not trying to compete. We're just trying to create things that nobody else has even done yet.
Correct. That's been my career since day one. I like to, break new ground, create things that have utility though. It's easy to come up with some crazy idea and get it out there that has no use case. But what are the use cases for certain products and are they represented in the marketplace today? So, factor investing is a very well used, particularly in the institutional space and the RAs. They love to use factor-based products because then this way, you can get a little bit more, exposure to companies that may perform better in certain markets. And factor loadings are multiple months in most cases, and even a couple of years in terms of longevity. So we're coming out of a market, as I mentioned, has several years of momentum-based returns. But now it's quality. Quality is the number one, value is second, very close. So, it's never been done before in the income space, and we think it's going to be as exciting as well, maybe not as exciting as Warren Buffett, but pretty exciting.
Absolutely. Follow-up question. How much does back testing play into your strategy creation?
You have to back test. I mean, all back tests look great, right? But it's really, for us, back testing is determining if the portfolio is providing the outcome we're going after. So for instance, for a factor-based product, you want to look at the, I don't want to get too wonky here, but something called Fama-French 4-factor model. So you want to run it through the 4-factor model, right? To make sure that it's the quality tilt is persistent through time and through multiple market cycles. So the only way you can do that is through back testing. But we're not back testing things to say, oh, this performed the best, let's get that out. I mean, with AIS, for instance, there was a million different ways we could have juiced it up. I mean, if we really wanted to juice up returns in the AI space, we would have done like everybody else and just load up on the Mag 7.
Right.
I mean, those are the top performers over the last, 3 to 4 years. So, we didn't do that. We specifically went for a portfolio that we believe had an institutional approach to, gaining access to the AI super cycle through investing in companies that most people don't have represented in the portfolio. Because one of the big risks in portfolio construction is, you buy an AI ETF that has 35% of its exposure in Meta and Amazon and Apple and whatever. You already own those securities, most likely. You either own them in other funds or you own them in single stocks, most investors. So you don't need more of that, because then you're introducing over concentration risk in your portfolio, and that is dangerous. Those securities go down, you're going to get hit really hard. So you need to diversify. So that means you really need to look under the hood on what you're buying. And that was, so AIS, for instance, the overlap between AIS and the other large AI ETFs out there, or even the Qs or the S&P 500, is extremely low. I don't want to nail it down, but I think it's 8% or something like that on average, the overlap. So we're providing exposure to companies with AIS that you just don't own.
Yeah, I think that's the key here. And that's really probably the biggest reason that people should go ahead and be looking at this is, where does this fit in my portfolio? Well, it does fit in because it's things that I don't have exposure to and I'm not already loaded up on. And so it creates diversification, but also has a company that is specifically targeting goals. It just makes a lot of sense to me. You're bringing me back to econ class with Fama-French as well.
Sorry about that.
Yeah, very fun. The more you keep saying Omaha, the more I'm like, we got to get Peyton Manning. This can be the first one to sponsor Peyton Manning as an ETF.
That would be
Omaha,
awesome.
Yelling it out.
Somebody put that like something like a little video up on the VistaShares site or on the X site with one of those. It was really funny. Yeah,
I love that
sponsor.
With the Berkshire meeting only coming up, what is that, in like 2 weeks, I think, as well.
Yeah,
with that, anyone from the team gonna go? We gotta get someone has to hold up the OMH sign. Remember the Janet Yellen where someone had like the buy Bitcoin in the back?
Oh my God.
You got to get that behind Buffett.
That'd be great. That would be great. Yeah. I don't know if you'd like that very much, but
probably, yeah, that's fair. That's fair. We'll Photoshop it in.
Yeah. I love it.
Very cool. Adam, this was a great conversation. I encourage everybody. We talked for about 30 minutes with yourself and John McNeil about the AIS ticker, that is the AI super cycle, targeting a unique set of exposure to the picks and shovels plays behind the AI ecosystem. Definitely a long-term hold, but also I think you're going to see a lot of movement in these next 3 to 5 years. And then we talked extensively here on OMAH, which is your VistaShares Berkshire Target 15 Select ETF as well. The holdings are transparent. People can go and see them on the website. Again, just vistashares.com, easy to find there. As always, my live streams, I love bringing on valued partners that I'm working with. This is a great place to start your due diligence. We don't make recommendations or endorsements of specific stocks or ETFs, but it is a great piece to start at the top of the iceberg and to trickle down from there and continue to just educate yourself. Adam, you've been very active on X as well. I would encourage people to follow you to get an education on these pieces, and as well as the VistaShares account. And we'll be doing more content, more spaces, more live streams, more posts coming up soon as well on both these topics. Any final comments before we close out on this one?
Yeah, I think you nailed it all. I will notice that, which is interesting, is that there seems to be a lot more action going on in the AI space over the last few days. I think maybe as the market is kind of eased up a little bit and gone, the right way up. So it's nice to see. So yeah, I would encourage you, as you mentioned, go on the website, pull up the research. Just look at our research. Look at we have a white paper on our website. If you have an extra, half hour and get really deep into the methodology, I think you'll like what you see.
100%. And if you want to listen to it from an audio perspective, keep an eye out for our next space. We'll share more details on there. Maybe we'll go a little bit deeper into the methodology on there as well. Thank you to the 9,410 people who have tuned in for the past hour with us, hanging out. We look forward to the next one. Take care, everybody. And Adam, thank you again for